Have you ever noticed how the market seems to reward patience, but somehow punishes most people anyway? While long-term investing is often praised as the safest approach, many investors still end up frustrated, underperforming, or giving up entirely. In this video, I'm going to explain why the market rewards patience in theory, but punishes almost everyone in practice, the common behaviors that lead to poor results, and how a small shift in mindset can put the odds back in your favor. Understanding this gap is key to becoming a better investor. Before we jump in, if you want thoughtful investing insights that help you avoid costly mistakes, hit the like button, subscribe, and turn on the bell so you don't miss future videos. Everyone knows the secret, but almost no one uses it. Here's the irony. Long-term investing isn't a secret. It's taught in schools, preached by experts, and backed by decades of data. The S&P 500 has returned around 10% annually over the past century. If you invested $10,000 and left it alone for 30 years, you'd have over $170,000. That's life-changing money from doing absolutely nothing. So why aren't we all rich? Because knowing what to do and actually doing it are two completely different things. The market doesn't just test your knowledge. It tests your emotions, your discipline, and your ability to go against every natural instinct you have. And that's where most people break. The real enemy isn't the market, it's you. The biggest obstacle to long-term investing isn't a market crash or a bad stock pick. It's human psychology. We're wired to react. When the market drops 20%, your brain screams at you to sell. When a stock doubles in a week, you feel stupid for not buying it. When your neighbor brags about making quick profits, you feel left behind. These feelings are normal, but they're deadly for investors. The market preys on fear and greed. It shakes you out during the lows and lures you in during the highs. And the worst part, you won't even realize it's happening. You'll convince yourself that this time is different, that you're making a rational decision, that you're protecting your money. But really, you're just reacting. Patience sounds easy until you lose money. Holding stocks for decades sounds great when you're reading about it in a book. But it feels impossible when you're watching your portfolio bleed. Imagine this. You invest $50,000. 6 months later, it's worth $35,000. You've lost $15,000 on paper. Your stomach churns every time you check your account. Your spouse is asking questions. Your friends think you're crazy. Every financial news headline is screaming doom. And here's the kicker. This is normal. The market drops 20% or more every few years. But when you're in the middle of it, it doesn't feel normal. It feels like the end. And that's when most people sell. Not because they plan to. Not because they don't believe in long-term investing. But because the emotional pain becomes unbearable. They sell to stop the bleeding, to regain control, to feel like they're doing something. And that's exactly when they lock in their losses. The market doesn't care about your feelings. Here's a harsh truth. The market will do whatever it wants, whenever it wants. It doesn't care that you need money for your kid's college next year. It doesn't care that you're stressed about retirement. It doesn't care that you just bought at the top. The market operates on its own timeline, and that timeline is almost never convenient for you. This is why patience is so powerful and so rare. When you commit to long-term investing, you're essentially saying, I'm okay with short-term chaos because I trust long-term results. But most people can't handle the chaos. They need certainty. They need control. They need to feel smart. And the market offers none of that. So they jump in and out, trying to time the perfect moments, and they end up worse off than if they'd done nothing at all. The people who win are the ones who do nothing. The greatest investors aren't the ones who make brilliant moves. They're the ones who make no moves at all. They buy quality investments and then ignore the noise. They don't check their portfolio every day. They don't panic during crashes. They don't chase trends. They just wait. And waiting is agonizing. It feels lazy. It feels like you're missing out. But that's the point. The market rewards inactivity. Every time you trade, you pay fees. Every time you sell, you trigger taxes. Every time you react, you increase the chance of making a mistake. The people who get rich from investing aren't smarter than you. They just have the discipline to do nothing when everyone else is panicking. Why most people quit right before the win. There's a cruel pattern in investing. Most people give up right before things turn around. They hold through the pain for months or even years. And then finally, when they can't take it anymore, they sell. And of course, that's when the market recovers. It's not bad luck. It's predictable. The market always recovers eventually, but you have to be there when it happens. If you sell during the crash, you miss the rebound. And the rebound is where all the gains are made. Some of the best days in market history happened right after the worst days. But if you're on the sidelines, you don't get to participate. This is the trap. The pain of holding feels unbearable, but the cost of quitting is catastrophic. And most people only realize this after it's too late. The truth about market timing. Let's talk about timing the market. Everyone thinks they can do it. Buy low, sell high. It sounds simple, but here's the reality. Even professional fund managers with teams of analysts and supercomputers can't consistently time the market. So what makes you think you can? The data is clear. Missing just the 10 best days in the market over a 30-year period can cut your returns in half. And those best days often come right after the worst days. So if you're jumping in and out trying to avoid the bad times, you're almost guaranteed to miss the good times too. Market timing feels smart. It feels proactive. But statistically, it's one of the dumbest things you can do. Patience is a competitive advantage. Here's the good news. If you can master patience, you have a massive edge. Because almost no one else can. The market is full of people who are smarter than you, richer than you, and better connected than you. But most of them still lose because they can't sit still. If you can buy good investments and hold them through the ups and downs, through the crashes and the boring years, through the doubt and the fear, you will beat the majority of investors. Not because you're a genius, but because you didn't quit. Patience isn't passive. It's one of the hardest, most active choices you can make. It's choosing long-term success over short-term comfort. And that choice is what separates winners from everyone else. When you step back and look at it, patience in the market isn't just about waiting. It's about staying disciplined when emotions are at their highest. Most investors don't fail because of bad investments. They fail because they abandon good ones too early. I'm curious, what do you think makes patience so difficult when it comes to investing? Share your thoughts in the comments. These conversations help everyone improve. If this video helped you see why patience is one of the hardest and most valuable skills in investing, don't forget to like, subscribe, and share it with someone working toward long-term success in the market. Thanks for watching, and I'll see you in the next one.